Good afternoon or good morning, everyone. Thank you for joining us today for the Capital Estimator for Mission-Driven Banks webinar. My name is Betty Rudolph, and I serve as the FDIC's National Director for Minority and Community Development Banking. I'd like to acknowledge my colleagues from the other agencies that have been instrumental in today's webinar as well. Joining us on the call today are Art Lindo, the Deputy Director for Bank Supervision and Regulation at the Board of Governors of the Federal Reserve, and Andrew Moss, the Director for Minority Outreach at the Office of the Comptroller of the Currency. Art and Andrew and their teams share the FDIC's MDI program's passion for promoting and preserving mission-driven banks, and we enjoy working collaboratively with each other to achieve this goal. Over the past several months, new funding commitments for FDIC-insured MDIs and CDFIs include $9 billion in potential Treasury funding through the Emergency Capital Investment Fund, new grant funding of $3 billion for CDFIs, including $1.2 billion that's set aside for CDFIs that are minority lending institutions, and millions of dollars in investments by large banks, private equity firms, private equity funds, and philanthropic organizations. To help you consider the impact that these funding opportunities will have on your capital ratios, the FDIC, OCC, and Federal Reserve developed the Capital Estimator and Guide to assist you. You can use the tool to conduct what-if scenarios on various components of your bank's capital stack, including the effect of equity investments from other financial institutions, private equity funds, the Treasury ESIP program, or potential grants made available from the CDFI fund. Before I turn the call over to my colleague Ben Bosco, I'll just provide a quick overview of the agenda for today. Ben Bosco, Chief Capital Policy, will provide an overview of the tool and guide, followed by Kyle McCormick, Capital Markets Financial Analyst, who will provide a demonstration of the Capital Estimator. We've set aside ample time today to answer your questions following the demonstration, and we have a team of capital markets experts from all three agencies, the FDIC, Fed, and OCC, to respond to your questions. Finally, Bobby Bean, the FDIC's Deputy Director for Capital Markets and Accounting, will provide closing remarks. For the webinar today, you'll be in listen-only mode. You may ask a question at any time using the Q&A button found at the top right of your screen, and I think Ben will provide instructions for this in his introduction. I'll turn it over now to Ben Bosco to start today's webinar.
Thanks, Betty. Hello, everyone. My name is Ben Bosco, and as Betty mentioned, I work in capital markets policy at the FDIC. Sorry, I'm just in the process of sharing my screen. So, staff from the OCC, the Federal Reserve, and the FDIC have developed two resources to assist minority depository institutions and community development financial institutions in understanding the effects of capital investments on their regulatory capital requirements due to the potential of capital investments to the various initiatives that Betty had mentioned in her remarks. So the first resource is a regulatory capital guide, which provides an overview of key considerations regarding the effect of capital investments on an MDI or CDFI's regulatory capital requirements under the agency's regulatory capital rule. The second resource is an Excel-based estimation tool, which allows an MDI or CDFI to proxy the effect of the capital investment on their ratios. So these resources can be found on each agency's websites, which I'll now show you all on the following slides. So for OCC supervised institutions, you should navigate over to the OCC Capital webpage on their website, and you can see here on their Capital webpage, if you scroll down to the references and related links, where you can find the Capital Estimator on their website. For Federal Reserve supervised institutions, you can navigate over to the fedpartnership.gov website, And then once you get to that website, if you click on Forms and Guidance, that'll bring you to a separate web page. And then you can scroll down to the capital section on that web page where you will also be able to access the Estimator tool. Finally, for FDIC supervised institutions, you can head over to the fdic.gov/MDI homepage. And you can see, once you get to that homepage, you can see that you can access both the guide and the tool for mission-driven banks or MDIs or CDFIs. So these web pages are live, so you can go right now to the web pages to download the tool and the guide, for your convenience. Now I'll just provide just a few screenshots to help you understand better how to ask questions during the presentation. So as Betty mentioned, so to ask a question, you should see a question mark icon to the right of the Leave button on your screen. So what you would do is you would click that button, and then a separate, separate kind of text box would appear on the side of your screen, where you will be able to type in your question. And once you do that, you would press Publish. And then that question would then be submitted to myself and other folks who are part of the presentation team, and we'll be able to review that question and provide an answer to you during the Q&A section of this webinar. To the extent that we're unable to get to a question, we'll be sure to follow up with the institution with a response afterwards. So now, actually, I would like to turn the webinar over to my colleague, Kyle McCormick, who will provide a demonstration of how the Estimator tool works. Kyle?
Okay, thank you, Ben. So I'm sharing my screen here. So we have the tool. When you open the tool, the first thing you will see here, the Estimator tool, is a disclaimer box that pops up. So this disclaimer explains in a general way what the tool is to be used for, which I'll go through, and also emphasizes that this tool is just for estimation purposes. It's not to be used for any supervisory or business purpose. It's just for estimation. So you can click through here, accept. This brings you to the instructions page, and so we reiterate some of those details in the top section here. And then it goes through step by step exactly how to use the tool, and in fact references specific cells. So I'll do that right now. So I'll switch to the IDI Estimator tab. So this is for depository institutions, and so I'm going to enter a cert of an example bank. So this is not a real bank, but just inserted for example purposes. So this is called Example Bank 1. And at the top left here, you have some summary information about the bank that will populate here. So you have the state, the primary federal regulator, the FDIC region. You have a CBLR indicator. So this bank is not a CBLR electing bank. You have an S Corp indicator. And then you have some numerical information here, including assets and some capital figures, your regulatory capital figures, common equity tier 1, additional tier 1 capital, tier 2 capital. And you have your average risk weight, which is your risk-weighted assets divided by total assets. So that's at 60% for this example bank. Then you go to the top here, you have your current capital ratios. So these are just simply your reported ratios as of 4Q 2020. So you have your 3 capital ratios and your leverage ratio. There's a PCA category row right here that looks at the ratio immediately above and indicates what PCA category just that ratio would be. And then you also have an exceeds the CCB, the capital conservation buffer, and that's just a simple yes or no. And so you see here for this example, all of these ratios are above the well-capitalized threshold. They all exceed the CCB. So then you come to step 2, where you enter, or you can pick a capital type. to simulate an investment. So we have the three regulatory capital types, CET1, AT1, and Tier 2. There's also an option to enter an amount of non-regulatory capital. For example, this could consist of senior debt or deposits. And so we have a description of what the likely instruments that would qualify for each type of capital. And then below that, step 3, final step, you enter the risk weight bucket that you'd like the invested funds to go into. So we have a variety of risk weights here that you can use to simulate. We also, at the right side, we have the average IDI risk weight. So that's the, from over here, which I explained, the average risk weight, RWA divided by total assets that you can use as well. And then you have the post-investment capital ratios at bottom. So I can do a example here, entering a $10 million, so this is in thousands, so a $10 million investment in additional Tier 1 capital, for example. And then you need to fill in that same amount in one or multiple risk weight buckets. So I'll put that 10 million in the 100% risk weight bucket. And then you can look down here at the post-investment capital ratios and compare those to the current capital ratios at the top. And so you'll see CET1 goes down because CET1 capital was unaffected. Tier 1 capital, capital ratio, total capital ratio, and the Tier 1 leverage ratio all increase because Tier 1 capital increased. So this was an investment in additional Tier 1, so it made Tier 1 capital increase. So we can reset here and maybe try a investment in a non-regulatory capital. So we can do 10 million, put it back in the 100% risk weight bucket. And so this is an investment in non-regulatory capital, so it does not affect the numerators of your capital or leverage capital ratios or leverage ratio. And so what you'll see here is a decrease in those ratios because the denominators of those ratios increase. The numerators, the capital amounts, are unaffected in this example. I should also mention, so we have a PCA category flag here, a PCA change flag. So if it changed, if the individual ratio changed PCA category compared to the current ratios above, and also again, whether it exceeds the capital conservation buffer threshold. So now I'll enter a CBLR bank. So reset these amounts. So this is a different example bank. We call this example bank 2, and this is a CBLR electing bank. So you'll see the CBLR flag right here says yes. So this is exactly the same as the last bank, except that this bank is a CBLR bank. And so you'll see their capital ratios above say NA because the capital ratios do not apply to CBLR electing banks. The leverage ratio is reported. So that is your CBLR ratio. So we can do a similar example here. So a $10 million investment in AT1. And for a CBLR bank, so you'll see this line right here, step 3. So risk weights are not applicable for a CBLR electing bank. So you do not need to fill in anything in this risk weight row right here. You can go straight to the post-investment capital ratios. And as you see, the leverage ratio increases to 15.6% compared to the initial 10% above. So with that, I will go to the BHC Estimator tab. So this applies only to Y9C filing holding companies that are parents of MDI or CDFI depository institutions. So I have an example here, BHC example 1. again, just a fictional holding company for example purposes. So we have much of the similar information reported up here. So this is a $15 billion holding company. It is not a CBDR electing bank. And so you have a similar format as the IDI Estimator tab. You have their current ratios reported at top, current risk-based ratios and their leverage ratio. And you have a flag indicating whether it exceeds the capital conservation buffer and whether it meets or exceeds the minimum threshold for each ratio. You don't have a PCA flag here because the PCA does not apply to holding companies. So then you have your step 2 where you choose the investment type. So these are the same as on the other tab. You have your 3 types of regulatory capital and your non-regulatory capital, a description of what constitutes each. And step 3 is the same as well. You have your risk weight buckets that you can choose from. So we can try an example here. We can put 100 million in additional Tier 1 capital. And so you'll see an error message will appear if you don't insert the same amount in one or multiple risk weight buckets. So we'll put this in the 100% risk weight bucket. And then you can look at your post-investment capital ratios. So you'll see the CET1 ratio declines slightly because this investment is an additional Tier 1, so it doesn't affect CET1 capital. But you get an increase across the remaining ratios, the Tier 1 capital ratio, total capital ratio, and the leverage ratio, because the Tier 1 capital amount increases, and that affects those remaining ratios. So I think at this point, I will turn it back over to Ben Bosco for some Q&A.
Okay, great. Thank you, Kyle. So we did get a couple of questions that came in. And I think I'll actually turn them over to Betty to answer, Betty Rudolph from the FDIC. So the first question is about whether or not the webinar is going to be recorded. Over to you, Betty. Yep, thank you.
Thank you, Ben. Yes, today's webinar is being recorded, and all of the agencies will post a copy of the webinar on their websites, the websites that Ben shared earlier. So you can refer back to it in the future, or if you need to drop her off early today. Back to you, Ben.
Great, thanks, Betty. And actually, so I'm just going to go back to you. I guess we're playing tag here. So the next question is, can an MDI or CDFI designated as troubled condition apply for ESIP? So that's more a question about the program than it is specifically about the tool itself. So Betty, can you help answer that question?
Yes, Ben. MDIs and CDFIs that are designated by their primary regulator as in troubled condition are not eligible. And that's spelled out in the statute that created the Emergency Capital Investment Fund, which is a program that's run by the U.S. Treasury Department.
Okay, great, thanks. So we did get another, as we're waiting for more questions to come in, there were a few other questions that I thought maybe we could answer about the tool that could be helpful. And Kyle might have gone over this as part of his remarks, but you know, one thing we just wanted to clarify is can the tool be used to estimate the effect of a capital investment outside of the ESIP program? So the answer to that question is yes. You know, the tool can be used to estimate the effect of capital investments on a bank or a holding company's regulatory capital ratios, even if that investment is made separate and apart from the ESIP program. And in addition, you know, I think as Kyle probably demonstrated, You can also proxy the effect on your regulatory capital ratios of a non-regulatory capital investment. So that functionality is also available in the tool, just so you can see what the effect on your ratios would be. So we're just getting questions in and we're going through them. Okay, so another question that we have is, so what is about, and again, it's about the tool. So what is the interaction? What is the interaction in the tool between the IDI tab and the BHC tab? And this obviously would be relevant for those banks that have a holding company that files a Y9C. So oftentimes a holding company will get the capital investment and then downstream the capital to the bank. So the way in which the tool would work in that case is you would go into the BHC tab. You would input the capital investment for BHC purposes, and then that would tell you what the capital ratio, the estimated capital ratios would be for the BHC. The tabs are not linked, so then you would a bank in that case would then separately go to the IDI tab, and they would then determine how much of the capital would be downstream for their purposes, and they would then separately estimate they would separately input the amount into the IDI tab to see what the effect of the downstream capital would be at the bank level. So it would be kind of for those banks that have Y9C holding companies to use a tool when you're downstreaming capital, it would be sort of I guess you could say like a two-step process to see what the impact would be at the bank. Okay, so another question that we have is, as Kyle showed, there's a choice of risk weights that you have when you're trying to show what the effect of the capital investment is, either at the bank or the holding company. And we designed the tool to be flexible. Typically we would think, when a capital injection initially happens, we would assume that perhaps at the onset, perhaps the investment would just be made in cash, and so in that case, you could choose a 0% risk weight to see what the effect of that initial investment would be at either at the bank level or the holding company level. But in addition to that, obviously the intention, at least of the ESIP program, is for MDIs and CDFIs to use that money to use those capital investments to lend. And the tool has the choice of risk weights of 0% and 20, 50, 100, and other risk weight choices. So that enables the user of the tool to then, so say if they were going to make a loan a consumer loan, that would be risk weighted at 100% under the agency's risk-based capital rules. They could then place that up. They would then place the amount of that capital investment in the 100% risk weight category, and they would see how that effect would, or how that 100% risk weight would impact their regulatory capital ratios. I mean, similarly, if a bank was going to make if a bank was going to use the capital investment to make residential mortgage loans, that would qualify for a 50% risk weight under the agency's capital rule. You could also then take part of the investment and place some of that into the 50% risk weight bucket, and you can see the effect of the ratio. Then, and in addition, you don't have to put all of the investment into a single risk weight cell. You could also, you could input amounts of the investment across different risk weights, based upon how a bank would potentially foresee itself making those capital investments. Okay, so we do have another, it seems like we have several questions about the program. So Betty, about the Treasury program, that is, rather. So Betty, I'm going to turn this one over to you. Is this Treasury's final ruling, or is it just an interim ruling? And might we be able to apply if our regulators don't object to the application?
Thanks, Ben. So the question, I think this is a follow-up to the question on whether an institution that's designated in troubled condition by their primary federal regulator, whether or not they're eligible. And the question is Treasury likely to change their mind on that? Or is it a final provision? And I would just say that that provision is in the statute. So I believe that Treasury's counsel and the agency's counsel have interpreted the plain reading of the statute is that those institutions in troubled condition would not be eligible for the ESIP. I would encourage the person who submitted the question, though, to visit the Treasury's website for the ESIP program. They have a mailbox there, and you can communicate directly with Treasury about that. Thanks, Ben.
Okay, so another question that's come in, and I can hand this over to Bob Bean. So the question is, will our regulator want to see the use of this tool as we establish an amount for our application?
Thanks, Ben. This tool is provided as part of our technical assistance we'd like to provide to you. It is an opportunity or a way to analyze the impact that various investments or grants or other types of infusions will have on regulatory capital impact. As such, its use is not required. We do not require its use as part of any type of application process. However, we hope that you will find use in this tool as a kind of a quick and convenient way to do an analysis as to exactly how will a investment, say from ESIP or some type of grant, how will this impact us on both the holding company level, if you have a holding company, and the IDI level. Thanks.
Okay, so another question we got in, I could try to take this one, is will links to the tool be shared via email? So the link to the tool are going to be available on the agency's websites along with the capital guide, and I had walked through that at the onset of the webinar where I showed the screenshots to the different web pages. So that would be the place you would go to access these resources. Okay, I'll take another question here, and I mentioned this as part of my remarks before, but I see a question about it now, so I'll just go again. So the question is, our understanding was that as an S corp, we would receive funds in the holding company as tier 2, and it would be pushed down to the bank as tier 1. Where would I put that in the tool? So I believe I went over that, but I'll just for clarification purposes, I'll go over it again. So in the tool, there are 2 tabs. There's a BHC tab, and then there's an IDI tab. So to the extent that you have a holding company that files a Y9C and you're able to access your information through the BHC tab, you would use that tab to to input the amount of the tier 2 investment, and then that tab would then show you what the potential effect would be on the BHC's regulatory capital ratios. But then you would separately have to go to the bank tab and input the amount at the bank level as a tier 1 investment to see what the effect would be at the bank level. So like I said before, it is a bit of a two-step process. And of course, in both cases, in addition to inputting the amount of the capital investment, you would also then have to select what the risk weight would be of that investment for those banks that are not CBLR banks. Okay, another question about the program, and I'm going to turn this again over to Betty Rudolph, but let me just, I can read it out to you all. So it says, do you know if a bank that applies for ESIP will be able to potentially reduce the requested amount prior to the final agreement? Betty?
Yeah, so I would encourage the person who asked that question to reach out to the Treasury Department and have a conversation with them. And again, they have the mailbox on the ESIP program website where they can respond to that question. And I'll just take this opportunity to mention that we have been working with the Treasury Department to create a webinar such as one we're having today with details for bankers on for MDI and CDFI bankers on the details of the Treasury program, and we have a call with them tomorrow to talk about the details of that.
Okay, we're just scanning the Q&A box to see if we are receiving additional questions. We did get a compliment, which for building the tool, so we appreciate the positive feedback. That's why that is why we developed this tool for you all to use. Okay, folks. So we're not getting any more questions. So oh, maybe we just did get a question. Okay. Yep. So we're not getting any more questions. So we hope that you found this presentation helpful today. And of course, you should, if you have questions in the future, you should feel free to reach out to your MDI contacts, and of course your primary federal regulators, and the other usual contacts you have at your PFRs. And yeah, so I thank you for your time, and I'd like to turn the presentation over to Bob Bean for some closing remarks.
Well, thank you. But before we go to a closing remark, we did have one last minute comment come in that I'm going to turn over to Kyle. Kyle, there's an issue about the RIS ID not showing up. Could you, if you see that comment, could you reply to that, please?
Take a look here. I'm sorry, can you read the...
It says my RIS ID is not showing for my bank holding company as a CDFI, but it is one.
Okay, yeah, so this I mentioned this only applies to Y9C filing holding companies. And so if it's not a Y9C filing holding company, then it will not appear. So that's, would imagine that's the issue here. So I think that's probably the issue. However, they can always reach out to me or one of us on the call. Happy to follow it up if there's some other issue.
Okay, and Ben, I think we got before we leave that question, we got a response. Yes, that they are a Y9C filing organization. I would ask that since I don't know who your PFR is, if you could email capitalmarkets@fdic.gov, we will take a look at that issue and resolve it for you. The last question, will sub-debt for S-corps be counted as debt at the holding company level and impact debt to equity ratios? This sounds like an excellent opportunity if one of our friends at the Fed would like to respond to that question.
We're just getting unmuted, Bobby. Give us a second. Sorry about that.
Absolutely. That's the wonders of technology, is we can have an unprecedented number of people available to answer questions, but we have very small buttons, and as far as myself, very old people.
Old eyes and small buttons. All right.
Art, I can answer that question.
Go ahead, Naima. Thank you.
Sure. I was trying to get my camera on. There it is. Okay. The answer is yes, but we would encourage you to work with your primary regulator because double leverage could be a supervisory concern.
Okay. Thank you, Naima. We really appreciate that, and I think it's even though you saw a lot of individuals from the FDIC speaking today, I want to let you know that this has been truly a interagency effort. So I want to thank all of our colleagues from the OCC and the Federal Reserve Board for working with the staff and the team at the FDIC to pull together this capital guide and the calculator that we went through today. As Ben mentioned earlier, links to these both of these assets are on the respective agency's website. I also want to respond to a question that I've gotten several times, and this is with respect to the ESIP program. As far as I'm concerned, it's unfortunate that it was termed as the Emergency Capital Investment Program. The FDIC, and I think I speak for the other agencies as well, we do not view this as TARP. We do not view an institution that takes the ESIP as having no other option as it being an emergency or any form of rescue capital. The agencies have worked very hard and very closely with the U.S. Treasury under the terms of the statute, that they had to apply in order to create a capital instrument that we view as a viable long-term capital instrument. We do not view an investment in this through the ESIP as being anything less than any other capital investment. So we don't view it as some sort of second-class investment. We do not view it as any type of bailout or emergency investment program. We view it as an opportunity to put funds into institutions so that we can help serve those communities that are most in need, particularly those communities that were disproportionately impacted by COVID and the latest economic downturn. So as far as I am concerned, I think this is a long-term capital instrument that should be considered and should be viewed as a viable hold forever type of investment instrument. Also, you know, the calculator that we provided today is, is intended to help you analyze the investments in through ESIP and through other types of programs. It's not all inclusive. Obviously, there are a lot of other issues that you need to think about. And, please feel free to reach out to your primary federal regulator if you have questions, or to reach out for technical assistance. I appreciate everyone's attendance at the webinar today. As we mentioned earlier, this will be recorded. It has been recorded. It will be presented on the agency's websites for future views. And as Ben mentioned earlier at the very beginning, and I know folks were like trying to figure out the technology to get online. It took me a little while to get online, to be honest. Is that there is a link at each of the different agencies' websites that you can go to. At the FDIC, it's FDIC/MDI, where you can find the links, and there are also links at the OCC and the Fed's website as well. So when you watch the video one more time, you will be able to see them again. So with that, I want to thank everyone for their time, and I want to thank the staffs from the other agencies again for all their hard work in pulling this together. So thank you very much.